Hello and welcome to Lecture 12 of Financial Statement Analysis. Today we're finishing up the subject with our final lecture. I've broken this lecture up into two parts. Part A is concluding comments and revision of the material, and then Part B will be a discussion of the final exam, the structure, and how the online exam environment is going to work. To start our revision lecture, I thought I'd go back to Lecture 1 and see how we started the subject. In Lecture 1, I put forward two goals for the subject. The first goal was to learn how to analyze and value a business. And then more specifically, I said, we want to learn how to value a business using a framework for business analysis and valuation using financial statement analysis. Learning how to value a business, we could have just done a price multiples kind of setup and valued a business using that methodology. However, we wanted to be more comprehensive and more detailed, so we learned a full framework for business analysis. So, do you think you've reached those goals? The individual assignment was due last night, so now you will have all completed evaluation. So I think you can get a tick for learning how to value a business, and you've gone through the whole approach from starting with an economic and industry analysis all the way through financial ratio analysis, forecasting, and applying multiple different valuations. So you have actually applied a consistent framework for valuing a business, and you'll be able to apply that to any business you wish to value or invest in the future. In the lectures, we've gone through a demonstration of Gale Pacific, and they were a really interesting case this semester because at the start, when we first started looking at Gale Pacific, their share price was around 9 cents per share, and they've actually doubled to 18 cents per share as of today. So picking a company that doubles in price in a couple of months is very rare. We're very lucky to see this one. I was hoping it was going to go up. I did pick it thinking some of the ratios indicated that it may have been an undervalued company, but to get a company doubling in value in that short time is really an incredible performance for their share price. On the other hand, we've also learned how to analyze many companies that were not so successful. We looked at Zinja, Thorn Group and their radio rental stores, and Chesapeake Energy in the tutorials, and we identified key problems with those businesses when we applied our different business analysis skills there. So overall, I think we get a tick for the goals in FSA. We had some more specific goals listed in Lecture 1 as well, so I thought we'd go through them and reflect on what we've done. We said we wanted to understand business analysis and be able to interpret financial statements and forecast financial performance, and you've done that in your assignments and tutorial work. The forecasting financial performance was really interesting this year because there's such uncertainty in the global economy due to the COVID crisis. We've observed lots of companies struggling and failing throughout the semester. We looked at Zinja, Radio Rentals, and Chesapeake, and within a week of our analysis of all of those companies, major announcements were made. Zinja closed their new bank accounts to new customers, Radio Rentals had all their physical stores closed, and Chesapeake Energy announced that they were likely to go into bankruptcy proceedings. Qantas had to cancel all their flights, and a huge mess in terms of how many staff they've had to make redundant. So all these companies, we've been able to do some simple business analysis, apply some of our skills that we've learned, and be able to then predict what is likely to happen with their businesses. For accounting analysis, we wanted to analyze if we could trust the financial statement data of different companies. And for the students who chose to do Boral for their assignment, during the semester, Boral has actually had an accounting fraud uncovered based on their American operations, and they were misstating their profits from those operations. So we've been able to see the importance of accounting analysis and how fraud can occur even during the semester that we've had. Another goal we had for this subject is to learn how to apply our valuation framework to different asset classes. So for most of the course, I've talked about valuing publicly listed companies. A few times I've mentioned valuing bonds applies to the same framework, present value of future cash flow, and bonds are much more easy to value than stocks because their cash flows are normally much more predictable because they're written into a formal contract. Last week in the previous lecture, we looked at private businesses and merger and acquisition valuation issues, and we touched on how we could expand our framework and make some alterations to value companies in these two instances. But we haven't talked about real estate, Bitcoin, art, or any of the other different investments that people could make. So we could apply the same present value of future cash flows concept to real estate. Real estate can be rented out. You could then estimate or forecast future rental inflows from owning the business or owning the real estate. You can estimate expenses of owning the real estate, all the council rates, maintenance, and everything you have to do to continue that ownership. You can then forecast your free cash flow from that investment and apply a discounted cash flow model to real estate. You would still have to think about your cost of capital, how much you're borrowing versus your equity investment, and the rates of those different costs of capitals to apply the discount factor. So you can apply the same valuation models in a very similar way to real estate investment. What about more alternative investments like Bitcoin or art? Well, if you buy Bitcoin, and that was really popular in the last couple of years, there's actually no cash flows that investors receive from this. There's no ability for an investor in Bitcoin to actually receive any cash flows. So we can't apply our valuation models. Similar story for most art investments and commodity investments. Investors in these products or commodities don't actually receive any investment returns. They're not getting paid any cash flows from owning these items. So in those situations, these are not really traditional investments. You can't apply traditional investment models or traditional valuation models to these investments. In fact, I would argue in most of the cases, these are not investments at all. These are speculative assets that you can purchase that may go up in value based on supply and demand, but they're more like consumer products. I could buy an old car, and that old car becomes very rare, and the price might go up because I have a rare old car, like a vintage car. Now, the price might go up and I might make money on selling it as the price goes up, but that wasn't really an investment in the traditional sense where I'm going to earn cash flows or returns over time from owning that. It's more of a speculation that I think this thing, such as Bitcoin, may become rarer in the future, and if demand increases or demand stays constant, then the price might go up. So these kind of things are more likely to be speculation based on, do you think the price is going to go up due to increasing demand for limited supply of the product? So as a warning, if you think investing in something like Bitcoin is a good idea, make sure you understand the risks involved and that you are just making a prediction based on the psychology of other people wanting to buy it more than you were willing to buy it. And you're not actually applying any sort of formal valuation or investment process to it. You may make money off it, but it's based purely on the psychology of other people wanting to buy what you've just bought more than you did in the past. There's no intrinsic value to these things. We said we wanted to improve your research skills in this subject, and your assignments involved a lot of research. We introduced some databases that many of you have not used before through the UTS library, which has many different databases that you can access. In particular, we looked at IBIS World, Mint Global. These were really useful for our industry analysis. And then Data Analysis Premium we looked at to get a whole bunch of data, including when we did the price multiples calculator. I had downloaded the earnings, market values, and cash flows for all the companies listed on the Australian Stock Exchange from Data Analysis Premium. So we got to use a lot of databases, which improves your research skills in being able to get data from different places and analyze it yourself. The two final things that I listed as goals for FSA were improving your technical skills, and by that I meant some of your Excel modeling skills. So we've used Excel a lot in this course. One of the advantages of the online learning model is you were all on your computers and you could use Excel during the tutorials and answer the tutorial questions in Excel during the classes. So we've used spreadsheets for all our valuation models. We built a really complicated price multiples spreadsheet in one of the tutorials. You've learned how to use multiple worksheets and reference cells across different sheets. A whole range of functions, from simple ones such as adding up things with the sum function, all the way to if statements and VLOOKUPs when we did the price multiples spreadsheet. So I think during my tutorials, I was able to witness a lot of people improve their Excel skills, improve the speed that they were able to do their calculations. And Excel's a really key skill in many graduate jobs. So improving your understanding and ability to learn new skills in Excel is really crucial. Finally, your critical analysis skills or your critical thinking skills. In this subject, probably more than any other subject you've done in your business degree, my answer when you've asked me questions has been, it's up to you. When it's come to forecasting, you've asked me questions, what should your forecast be? And I said, it's up to you. You have to apply your own thought processes, your own logic and understanding to an issue to come up with your own answers. I can't tell you if your forecasts are right or wrong because I myself don't know the answer to what's going to happen over the next 5 or 10 years. All I can do is understand your thought process and see if you're taking into account relevant information in coming up with your conclusions. The cost of capital calculations, again, many students were asking me, what should I use for my risk-free rate? What should I use for my market returns? All I could do is point you in the direction of what's happened previously based on prior research, but whether that's going to repeat in the future is uncertain. So it's up to you to think about these issues and make your own decisions. Again, there's no right or wrong answer. My way of doing things may not be any better or worse than what you come up with. It's up to you to think about the issue, reflect on the knowledge or what research has been done into the issue, and then use that information to make your best decision there, knowing that it might not be correct, and therefore doing sensitivity analysis. Thinking through your choices and going, my choices are probably going to be wrong. What happens if they're wrong in this direction or that direction? What's the sensitivity to my modeling? It's a really important skill set there, and FSA is unique in that different students can both be fantastic students and come up with completely different conclusions about a company. In lecture 1, I mentioned Tesla. They were one of the most short sold stocks in the world. Billions and billions was bet that that company was going to fail. And I think as of yesterday, the Tesla stock price has again risen over $1,000 per share. So there's really sophisticated investors who, using their critical analysis, thought the company was going bankrupt. There were other sophisticated investors who thought the company was going to be a huge success story. And as of yesterday, the share price has still been going up and they've been a very successful company. So let's do a little bit of revision of the subject. At the start of every lecture, we had this business analysis framework, and we've now completed our 5 steps through the business analysis framework. So I'm going to go through lecture by lecture and discuss some of the topics, and overall, here's what we hope you've taken away from the subject. So in lecture 2, we started off by talking about how industry is really important. The structure of an industry that a company competes in will have a really large influence on its overall profitability. So the main thing we looked at there was Porter's 5 forces. You're going to need to know Porter's 5 forces, and reading chapter 2 is a great place to revise for Porter's 5 forces. If you can remember this figure, the different forces and the subcomponents of each of those forces, that's going to be really helpful in being able to apply Porter's 5 forces to any particular industry or company that you want to value. Even up to last night when you were submitting your assignments, you would have been referring back to your industry analysis. When you were doing the final steps of the assignment, such as the terminal value growth rate assumptions, heavily influenced by the industry profitability and competition within the industry. When you're doing your management consulting advice, the ability for your company to earn returns higher than its cost of capital and being able to provide advice to managers on how they could improve this, heavily influenced by your industry profitability. So Porter's 5 forces is really powerful, and it does come in really handy for your valuation work in being able to predict what's likely to happen in the future based on competition within an industry. In lecture 2, we also looked at competitive strategy. So again, read chapter 2. We broke companies down into either cost leadership or differentiation categories, and there were subcomponents that businesses would have to succeed in to ensure that they were successfully implementing those strategies. In lecture 3, we moved on to accounting analysis. In accounting analysis, we said accounting data often has distortions, and those distortions can be caused by 3 factors. Noise from accounting rules. That was when the accounting standards maybe didn't allow a business to reflect its true value on the balance sheet or income statement. And we used examples like, for a pharmaceutical company, their research has to be an expense item, even though that research could lead to very valuable assets being created in the future. We learned that there's forecast errors, and we talked about simple things like depreciation or accounting for bad debts. You have to make assumptions about what's likely to happen in the future, and if your forecasts are not correct, your accounting quality will decrease as well. But that's just innocent mistakes that are bound to happen. And then finally, we learned about managers' accounting choices and how there's different accounting rules that can be applied to the same situation and how that will lead to different financial statement outcomes. We then went into a lot more detail about how managers may have incentives to bias the financial reports and earnings management and why it's likely to happen and when it's likely to happen. So you'll need to make sure you revise over those issues. And chapter 3 of your textbook's really useful for your revision there. Lecture 4, the pace of the subject started to change. We started to do a lot more in way of Excel work and calculations and really looking at the numbers in more detail. So the first thing we did in lecture 4 was learn how to reformat financial statements. And reformatting the financial statements briefly was splitting the operating and financing activities apart on both the balance sheet and income statement. We also calculated free cash flows, and we also looked at the net payments to shareholders when we calculated D. So overall, the reformatting of the financial statements was this process of splitting the activities of the business into either operating activities, which create value or may create value, versus financing activities, which usually occur at the cost of capital and therefore don't create excess value for shareholders. So you need to understand the theory, you need to understand why it's done, you need to understand what the benefits of doing this are for our forecasting and valuation approach, and there were lots of examples to practice this for your study. The Gale Pacific spreadsheet is split up into operating and financing activities. There's the practice practical question, which is in the learning material folder on UTS Online. There was tutorial work on it. There was demonstrations in the lecture, Qantas, and obviously you've done it for your assignment as well. So make sure you can go through and reformat the balance sheet and income statement quickly and easily and understand all the steps in doing so. During lecture 5, we looked at ratio analysis in a lot of detail. So the main thrust of lecture 5 was learning how to break down return on equity into its profit margin times asset turnover. That was our return on operating assets, plus the financing component, which was financial leverage times spread. So make sure you're comfortable calculating all of these ratios, and they do require you to have reformatted the financial statements first. These ratios are given to you in your formula sheet in the exam, so you don't have to memorize these, but you do need to be able to comfortably reformat the statements and apply these ratios, and you then need to be able to interpret the ratios. There was also liquidity and solvency ratios that we discussed, and you should be comfortable understanding, both calculating and understanding what those ratios mean and discussing any issues with those ratios. Again, plenty of practice examples, the Gale Pacific spreadsheet, the practice practical question, lecture 5, the tutorial questions, Qantas, and your own assignment. So there's plenty of material to go back and check that you are capable of calculating the ratios and you understand what they mean. The next topic was forecasting, and that comprised of 2 lectures. The first lecture on forecasting, we looked at the forecasting template. So I really want you to understand how that forecasting template is built, the key items that you had to specifically forecast, the sales growth rate, the asset turnover ratio, the profit margin, your net borrowing cost, your dividend payout ratio. You need to remember that they're the items that you have to forecast and what calculations are able to be conducted following those forecasts to allow you to create a comprehensive forecast of the firm's earnings and ending equity balances. So again, make sure you go through and do the practice of the forecasting template. This is not included in your formula sheet. I do hope that you understand how the different forecasts lead to the calculations and allow you to create a comprehensive forecast for your company. In lecture 8 and 9, we got to the valuation models, and we learned 5 different ways of valuing businesses in this course. Price multiples we talked about separately. We talked about how price multiples are a very quick and easy way of valuing a company, but there are a lot of inaccuracies. And we built a nice price multiple spreadsheet so we could see how the inaccuracies actually play out when you try and value companies based on their industry averages. We then learned 4 formal valuation models which apply the present value concept. You need to understand the calculations. You'd be expected to be able to value a company using any of these 5 valuation methods. You also should know the theory about what are the advantages and disadvantages of these 5 models, and when the models are most likely to provide an accurate or when they're most likely to provide inaccurate price estimations for your company. During lecture 10, we finished up the valuation process by understanding how to calculate the cost of capital. There were 3 types of cost of capital that we discussed: cost of debt capital, cost of capital for equity, and cost of capital for the firm. You need to understand the theory about what is the cost of capital. It's linked to the risk of a company, and it's the required return that investors require from the investments that they make. So investors demand higher returns for riskier investments. Equity is riskier than debt. So for a given company, the cost of equity capital will be higher. Investors will demand a higher return for buying shares in a company than if they lent money to a company through debt. Okay, so the practical side of things, you need to be able to calculate these 3 costs of capital. The capital asset pricing model is used for the cost of capital for equity. Okay, that's not given on your formula sheet. And the weighted average cost of capital is used for the cost of capital for the firm, and that's not given on your formula sheet either. So I want you to make sure you remember those different models. And then you need to understand the practical implementations. So you can apply these formulas, the capital asset pricing model or the weighted average cost of capital, but when you're actually doing it for a real company, what are the issues that you run into there? What are the choices you have to make? What are the ramifications of those different choices? How can that lead to different problems and inaccuracies in cost of capital estimation? So that finishes up a brief review of lectures 1 to lecture 10. In lecture 11, we went through a few extensions to the course, but lectures 1 to 10 are the main components that I really want you to take away from the subject. So as we're finishing up and you're heading towards your exam, you need to realize FSA does require a lot of practice. I know a lot of you have put in a huge amount of time into your assignment, and that's great news because your assignment actually does allows you to practice for your exam. So putting time into your assignment is all going to pay off when you actually come to doing the same sort of calculations and analysis in your final exam. As you study and as you study for your exam and have problems and have questions, please ask questions on the discussion board. I'll be checking that regularly in the lead up to the final exam. And overall, I hope you've enjoyed the subject. I hope you do feel that you've learned some new skills and that when you did your assignment, although it was a lot of work, I hope you actually did enjoy certain processes and parts of the assignment in coming up with your own valuation and have gained a much better understanding of how the stock market and company valuation works. Best of luck in the final exam, everyone. I hope you do really well and overcome the challenges of studying online this semester. In the next part of the video, I'll give a lot more details on the final exam. Thanks, everyone.